Hi everybody, welcome back to the Bill Heenan Real Estate Show. This is Bill from the Bill Heenan team in the state of Connecticut, and I'd like to welcome any previous viewers and certainly a big shout out to any new viewers. If you like what you hear today, please hit that big fat red subscribe button at the bottom right hand corner of your screen and you'll be notified about any of our new videos. And today I wanted to indulge into a age-old question: should I buy or should I rent? And I like to approach this question. It doesn't really matter what type of market that we're in. Right now, we're in a pretty strong seller's market, but it doesn't matter. Seller's market, buyer's market, high interest rate, low interest rate, higher prices, lower prices. The market is constantly shifting. So I think that you have to look at it from homeowner perspective, that I have to live someplace. I have to pay to live someplace. I can't live anywhere for free. So coming from the perspective of needing to pay to live somewhere, then the answer is always you should certainly buy and not rent, because renting, you're just throwing money into a fire. Own home gives you some significant advantages as far as equity builds in that new home. And there's a report that we put out, and I'm going to refer to some notes on the big board behind the camera here. And there's a report that we put out for our buyers, or at least we asked them if they'd like to have that report, and we call it the Future Home Equity and Investment Report. And basically that just breaks down the equity build points that we know that our buyers will discover or have take place over their length of ownership. And on this report for this video today, we wanted to base it on a 5-year time length of ownership. So the first question we ask any buyers that comes into the marketplace that asks us for some help is we ask, how long they plan to be in the house. And if they tell us that they only plan on being there for 2 years, then our suggestion is to probably rent. But if they tell us that they're going to be there for 3 years or longer, and most people do, a lot of people are generally in their homes for about 7 to 10 years at this point, I think, is the average ownership cycle. But if they tell us more than 3 years, then we know that's the break-even point. That's the point at which where you really should consider buying and not renting, because the monies that you're throwing at your housing is becoming significant, and you might as well get some of the advantages of ownership. And those advantages are this. There's 4 equity build points that we like to focus in on. One is the principal pay down. The other is the income tax savings. The third is your inflationary appreciation. And the fourth, which is the wild card, homeowner upgrades. And we're going to base this conversation on a buyer purchasing a home for $300,000, putting 10% down, $30,000 down, $8,000 in closing costs, so a total cash outlay in order to close on that house of $38,000, and a mortgage payment of about $2,000 a month. And that's based on a 30-year mortgage at a 5.5% interest rate with a little PMI, 65 hours a month in PMI, $3,600 a year in taxes, and $1,200 in homeowners insurance. Add that all up, factor that all in, run the calculator, and you come up with about $2,000 a month in mortgage money. If you were to rent that $300,000 house, which in our market is 3 bedrooms, 2 baths, maybe a colonial, maybe a raised ranch, you'd be paying somewhere between $2,200 and $2,500. $300,000 is a perfect scenario to compare to. Now, in our model, we just want to look at it as, I'm going to have a mortgage for $2,000 and I can rent for $2,000, although we know that the renting would be higher. And let's talk about these equity build points. Equity build point number 1, principal pay down. Over that 5-year term of you owning that home and paying that mortgage on a monthly basis, you're going to be paying down that principal about $345 a month. A total principal pay down over 5 years of $20,730. Now, it isn't $345 a month. It's an average of $345 a month, and that's because mortgage schedules are based on an amortization, an interest amortization schedule. So, and what that basically means is that the lenders, the person who lends you the money, is going to get most of their interest up front. Their fees and what they base their income on is going to get paid up front. Each month you will pay less interest and you will pay more principal. So the longer you're in the home, the more you're paying towards the principal in your favor on a monthly basis. But if you average it up over 5 years on 60 payment, then you are talking about an average of $345 a month with a total number of $20,730 towards the principal payment. That's pretty significant. I don't know if you went and rent for $2,000 a month. I don't think anybody's throwing $345 back at you to put in your bank account, but if you own your home, you will get that back in your pocket. In home equity build number 2 is the income tax savings. Now, this is a point that most new homeowners for sure don't really realize, and that is that as a simple filer of income tax, my mortgage home interest deduction is the largest deduction that I have in most cases. And what basically that says is that any interest or any taxes that are paid on that home with some limits, you could only deduct up to $10,000 a year on taxes, and you could only deduct mortgage interest on loans less than $750,000. But in this scenario, we're significantly below that. The taxes are only $3,600 a year, and the interest is based on a $270,000 loan. So we're well below the federal government cap. So, but what it says, once again, is that any interest and taxes paid on a yearly basis are a direct deduction for any homeowner, someone who's living in the house. That's significant. I mean, over 5 years, you're going to pay $89,248 in interest and tax payment. Now, a lot of people will be, oh, I shouldn't throw that money at that taxes and interest. Well, I explain it this way. You either pay your own taxes and interest, or you can pay your landlord's taxes and interest, because somebody's taxes and interest are getting paid no matter where you live, and you have to live somewhere. So when you think about it in that realm, it certainly starts to make sense, especially when you start to calculate that against your income tax bracket. Now, the average income tax bracket is probably somewhere around 20%. Most of the people in my area pay more than 20%, but let's use 20% as your income tax bracket. That means that on that $90,000 or just under $90,000 in taxes and interest that you paid over 5 years, you're going to get $17,849 back in your pocket. Now, once again, if you rent a home, nobody's giving you $17,000 back over your 5-year rental schedule, right? Which is an average of $297 a month. No one's giving you that back on a monthly basis, right? Only if you own a home. And I promise you, somebody's taxes and interest are being paid. They're just not yours. Equity build point number 3, appreciation number. So every home appreciates at least at the inflationary levels, the typical inflationary levels. Now, a lot of times they'll appreciate for more, sometimes they'll appreciate for less, but the average, if you check out some website, you'll find that it averages between 2.5% and 4.5% over a term of time. So the shorter the time, depending on when you pick it, it's a little higher. If you pick a bad time, then it's a little bit lower. The average is between 2.5% and 4.5% on any of the research that I did online. Now, we're going to base our calculations on 2%. And what we're basically saying is that your home will appreciate, or your home purchase will appreciate at least 2% a year, compounded annually every year until you sell it. We're looking at a block of 5 years. So in a 5-year time, the gain, the inflationary 2% compounding gain, is going to be $31,224. I've said that right. Over 5 years, your house will appreciate $31,224. That's money in your pocket. Now, what's so significant about that is that in a typical investment, you would look to see what your money out of pocket is and then measure the investment level at that point. Like if you were to take that $38,000 closing cost and put it into the stock market, the only gain you're going to get is against the money that you put into the stock market. I have the calculation. If you had an 8% gain on that $38,000, you'd walk away with about $17,000 on top of that $38,000. But that's not the way it works in the real estate world. In the real estate world, you get 2% on the entire purchase price. So 2% appreciation on the $300,000 gain, on the $300,000 purchase, compounded annually each year, which adds up really, really, really quick. $31,224 in this scenario. And then equity build point number 4 is your homeowner upgrades. Everybody who owns a home tends to do work on their home. I know I've always done work on my home. I know, anybody that I know is constantly doing work on their home. We help sellers all the time do work on their home, and we know that that work pays off. Now, in our typical real estate sale, when we go in and do a few $1,000s worth of work, we know that that return is 3 to 1. You invest every dollar with us, we do some work, you're gonna get $3 at least out of it. But I'm gonna use a very conservative figure because sometimes the best decisions aren't made, or maybe the best work isn't done. And let's say that every dollar in is gonna get you $1.50 out. That's a win-win in my book. But we do not include that wild card home ownership upgrades in our calculation because it's a wild card. I don't know what you're going to upgrade. I know that most people upgrade something, but I won't be able to really ascertain a realistic number. But realize that equity build point number 4 is a big one. And when you own a home, you're going to do some improvements to it. If you rent a home, you should not do improvements to it because the gain is not yours, it's your landlord. So that's 4 points. When you add all those up, $69,803 in gain. That's on your top of your $38,000 investment. That's an incredible gain. If anybody ever told me, hey, I will give you, if you give me $38,000 today, I will give you your $38,000 plus another $70,000 back, I would give them as many $38,000 as I had that's how good the gain is. It's somewhere around 190%. So it's not as simple as that, but there's nothing in this world that you can own and grab that kind of gain. So keep that in mind. And remember, this discussion is based on the fact that you need to live somewhere, right? You have to lay your head somewhere, and I hope you got some valuable information out of that content. And once again, this is Bill with the Bill Heenan Real Estate Show. Thanks. If you like what you heard, hit that subscribe button. If you'd like to hear some other topics, please mention them in your comments, and I look forward to seeing you next week.